This week, we're taking a step back to look at several broader market themes. Equities remain strong, with the S&P 500 up about 8% this year and the Nasdaq up over 10. Rates are firm, with the 10-year Treasury sitting near 4.5% and the 30-year just under 5%, reflecting both inflation concerns and growing worries about the fiscal outlook. Oil, meanwhile, is up more than 50% this year, though that may soon alleviate as reports indicate that the US and Iran are coming close to peace terms. Earlier this week, we received the May inflation data, which showed CPI back above 4%, rising to the highest level since 2023. The good news is that the details are better than the headline. Most of the recent acceleration has come from energy, while core inflation, which excludes food and energy, is running at 2.9%. If a peace deal holds and energy prices retreat, headline inflation should come back down, potentially giving the Federal Reserve more room to maneuver on rates. However, there's also a newer inflationary force at work. AI spending is showing up in the price data. Consumer prices for computer software and accessories are up 14.5% over the past year, while producer prices for electronic components are up nearly 27%, driven largely by a squeeze in memory chips, where data center demand has pushed some prices up more than 200%. Bloomberg Economics estimates that the memory shortage alone will add 40 basis points to headline inflation before it peaks early next year. Tech has traditionally been a deflationary force, and the key question is whether the AI era is fundamentally different. On the subject of costs, top of mind is whether the level of AI spending is sustainable. AI capex expectations are now approaching $1 trillion for 2027 for just the large US hyperscalers, with some analysts like Goldman Sachs projecting up to $1.4 trillion in spending. At the same time, free cash flow for the group is expected to fall from $236 billion in 2024 to just $37 billion next year. As we've previously discussed, investors will increasingly demand evidence that these dollars are earning a sufficient return. One place to look for that return is in pricing data, and right now, AI is being sold below cost. Consider subscription plans. A heavy user on a $200 per month Claude plan can consume up to $8,000 worth of compute. On ChatGPT's top plan, that figure can reach $14,000. While most users don't use their plans to max levels, it's likely that the pricing model for intelligence will need to change. As these firms move toward going public, we expect a more discretionary pricing approach to capture the value from the heaviest users of frontier models, offering up the highest levels of intelligence. As for tech more broadly, we're not ready to declare higher for longer, but we think it's safe to say that costs will be higher than before. Please let us know if you have any questions or feedback. Thank you and have a great weekend.